Welcome to the daily stock review of Westinghouse Airbraked Corporation, which is also known as Wabtec. Now, the goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months, 3 a day. So that sounds good. Subscribe to come along. Who am I? I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. This is my investing process. Today we'll go over how I came across this stock and the 5-minute check to see if it's worth looking into further. Learn from these guys. They do pretty well for themselves. They've got an awesome track record and they've left some breadcrumbs for us to follow in their footsteps. So we want to try and achieve some of that result. If you guys want the investing resources I wish I had when I first started out, you can grab those in the link in the description. Otherwise, let's crack straight into it. Now, Westinghouse Airbraked has risen pretty dramatically over the last few years in terms of its stock price, and it's got a PE ratio of 39 at this stage. So for this process, all I want to do is grab this annual report, just the latest one, and I've already cracked that open for us. Now, how did I come across this stock? So while I was doing some research into other railway type businesses, this one and a couple other businesses came up that are kind of offshoots to that. They provide the equipment for trains, etc. Pardon me. So an interesting add-on, and we'll see how it looks for a business. Now, net sales from 2023 to 2024 to 2025, looking at our income statement, we can see that sales has increased, and that's in millions. So it's 7.6 billion, 8.4 billion, and 9.2 billion. So we can see that this is steadily increasing. Now, what about our gross profit? So they're taking home 3.8, so a little over a 30% gross profit margin, which is fairly decent. And we've got some other costs that come out at the end of the day. Is there anything weird and wacky coming out? No, it looks fairly consistent there. Now, income from operations, we can see that's increasing as well. And then when we get to the bottom line, the net income, we can see it's gone from 825 million to 1 billion to almost 1.2 billion. So we can see that it's got some steady growth. It's not a double over a 3-year period. It would need to get to 1.6 or a little bit over. But it's still some pretty strong growth in the revenue of the business. And so what this shows me is that it has mastered its customer. If it's able to increase sales and increase prices, etc., it has been able to do that. And it also has some pretty strong margins within the business as well. So net income of 1.1, we're talking about it's bringing home a little bit more than 10%, probably a little bit closer to 15% net margins at the end of the day, which is pretty good. Now, let's have a look at the balance sheet. So what we do want to do is just make sure that what does it actually look like? Is the business healthy? And just a quick check of that. So we just want to do assets. Total assets comes to 22 billion. Total liabilities comes to 11. And we can see that our total assets is double the liabilities. So that's pretty good. Big things we want to keep an eye on is long-term debt and current portion of long-term debt that they need to pay in the current or in the next 12-month period. So that would be over the 2026. So we can see that that's pretty low, which is good. You can see it's also increased from the previous year to the most recent, but not a crazy amount. What's our main sources for assets? So we can see we've got some goodwill. and it's actually increased. So we want to make sure that we keep an eye on goodwill. Goodwill is a non-cash charge, and all it means is they've agreed to pay more than the usual market rate in terms of finance terms for either a business or an acquisition or something along those lines. And they've had to carry those costs on their business, or carry that, I guess, extra asset cost. Now, they do need to do checks on these every year just to make sure that that business that they've added on is actually in bringing with it the extra value from the assets. And otherwise, it can have an impairment expense, which could effectively wipe out some of that. So we don't want to say, for instance, if the only difference between these two assets and liabilities was the intangible the goodwill, I'd be a little bit worried, because at the end of the day, it doesn't count for too much if the business hasn't been able to get the extra juice out of that business. All right, let's go and have a look at the cash flow statement. So we've had a look at if the business has mastered its customer. It does look like the business has a good moat around the business, just in terms of the financial side of it. Like, it's not dwindling and dying off. And now I want to check to see if management's being rational with how it's spending its money. So over the years, we've got our net income that comes out. That's the bottom line from the income statement, and it becomes our top line for the cash flow statement. It goes through, we have some adjustments, and we end up with net cash provided by operating activities. So is there any things out of the ordinary in here, or large changes from year to year? Not really. So we go from 1.2 billion to 1.8 to 1.759. And so what's increasing? Inventories is increasing. So at this stage, that is outpacing the growth of the business. So 58 to 182 is more than double. Now that's a trend just for the time being, but if it continues, we want to see and we want to read up on what the business's strategy is here. Is it using and adjusting how much inventory it's maintaining for some form of reason? What's the strategy behind it? So we'd want to check what that is and if it's going to bring value to the business. We had a net gain on market-to-market derivatives and net loss on business disposition. So there's a couple of things that have come out that have reduced it for this year. Now, this one could end up being a one-off. These inventories could be a good sign. And what else is going on? Other accrued liabilities. All right. So what about our purchase of property, plant and equipment? So for this business and our acquisition of businesses net of cash acquired, so it has invested a lot of money into acquisitions relative to the amount of cash that it's making. In the most recent years in 2025. Now we want to read up on that if we're looking at this business further, to have a look for what are they expecting to gain from this business. Is it continued or extra growth on top of that and things like that. Now, purchase of property, plant, equipment. We want to get our free cash flow, which is this value, net cash provided by operating activities, minus this. So we've got roughly a little bit over 200 million. And we can see that it's increasing, 186, 207 to 260 million. And this is kind of the area where the business gets to invest its money and we get to see how the management team is planning on growing the business. If there was not a lot here, we wouldn't really expect it to increase. Now, because this value is increasing, it's usually a trend that they're saying, yes, they're investing in property, plant, and equipment, and they're putting in additional capex because they're getting value for money in terms of the returns. What else? So proceeds from debt. So they've bought some debt and they've paid some debt. Now the difference here is obviously gone into the free cash flow that's gone into the acquisition, as well as the extra debt that they've taken on for the most recent year. And it looks like that's a general trend, just balancing the payment of debt and acquiring a bit more debt, just to for that working capital. Now, repurchase of stock, they've been doing that a little bit, just with a little bit of cash that they've had. Though comparing that to our acquisitions and our purchases of equipment, it's only really flipped in the last year. What else are they doing? Maintaining a cash dividend as well, to a lesser extent. And it's a little bit less than what they're doing on terms of spend on property, plant, and equipment. So interesting. Always like a business that is focused and I guess prioritizing its efforts in one direction. Still doesn't mean that this is a bad business. It's obviously got some growth opportunities in terms of acquisitions. It's increasing its asset base by slowly increasing this. And it's repurchasing stock. So all that means is it's going to increase the value to the business, long-term shareholders eventually. Now, I'm not really a fan of dividends. Some investors are. That's fine. But always like a business that it's obviously, if a business does not have another place to invest its money to get a higher return on investment, then it should be offloading cash. I don't think that's the case here. I think with this business, I, from the conservative side, would like to see paying off the debt of the business, keeping it as low as possible, and then being able to plow as much as possible into property, plant, and equipment. And that's how we're going to find the fastest growing businesses that are able to make a higher return, while also being lower risk because of how it's structured, and they're able to finance their own growth. And so that is what a great business can do. Now, this one for me, this is definitely a great business to keep an eye on, pending if it has some hard times in terms of the shareholders and the price bounces back down. We could obviously see that there's been a lot more interest in it, and it's probably dropped down between 2015 up to almost over a 10-year period. It's stayed relatively flat. Now, it probably would be interesting to go back and check out those annual reports, but at this stage, with the growth that the business has got and the PE ratio, and some of these businesses could be sitting around a PE ratio of half that. It does show that they're expecting some significant growth to continue for the business. And so that growth has been priced in, hence why the price people are willing to pay is 40 times its earnings. So if you enjoyed this, feel free to subscribe, or if you guys are interested, check out this next video because YouTube reckons you'll like it. Cheers.